Thank you all for joining me today. My name is Christy. I'm a senior relationship manager here with Retirement Solution Group. I've been working here for about 20 years on the participant side, really making sure that everyone in a 401k plan with us, as well as our business partners, know where to go when they have questions, inquiries, have issues, and problems, with logging into their accounts or needing help with the crazy market situation that's we're currently going through now. So all things 401k, our team is really here to help you. I am joined today with my associate Megan. She is going to be helping me with the slides in the background. This session is going to be recorded, and a replay will be available within a couple of days of the conclusion of this session today. Everyone's going to be in muted status. If you would like to ask a question, feel free to use the chat box, and then we can address those at the end of the presentation. So let's begin. Let me get my screen started here. So the focus of today's presentation, it's a continuation of a topic which has garnered a lot of attention, well-deserved attention, in my opinion. And that topic is financial wellness. And even though our focus at RSG has always been proper saving and income replacement in retirement, we realized that our participants needed help with things other than retirement. It's kind of like with your physical health. If you have an issue with your blood pressure, you kind of have to look at all of the other factors surrounding your health. So similarly, with financial wellness, we need to look at a broader picture. So let's start with some of the most common questions that I get as it pertains to financial wellness. First of all, what does it mean? At a basic level, the simplest definition of financial wellness is really the ability to meet your needs while managing your money for short-term goals as well as your long-term goals. And there are intermediate-term goals too. So you can really break up by duration what your financial goals are. But in essence, you need to be able to meet your basic needs every month. So, your food, obviously, housing, transportation, healthcare, things like that. Are you bringing enough income in to support those needs, while at the same time creating buckets for all of your short-term, medium-term, long-term goals? So that is a pretty simplified definition of financial wellness. Another very common question that I get is, well, if I hit $1 million in my 401k, does that mean I am now financially well or financially healthy? The answer to that is no. Financial wellness, it's something that's dynamic, and it changes as you get older. So in each year, your needs are going to change as your family needs change, your healthcare needs change. So do your goals. So most people, unfortunately, will never reach a complete state of financial security. But that doesn't mean that you can't work towards that in every year of your working career. So, just because you hit a certain net worth, no, that does not mean suddenly you are financially healthy. It's much more encompassing than that. So how do you achieve financial wellness? It's certainly a lifelong project, let's call it. And, one of the core ideas I want to convey in this presentation today is that it's much easier to tackle this huge project when you break it up into smaller chunks or smaller time frames. And in this case, we like to look at it in different career stages, or you can choose to look at it based on different ages, and wherever you fall in that spectrum right now, you can really look to see if you're on track and doing the things that you need to be doing within your current stage, but also making sure that you've accomplished everything in the prior stages too. So the way that we're going to look at the topics today is really based on budget, debt, savings, and insurance. So being financially healthy, basically, it's defined as you are enjoying your life. You're not living beyond your means. You're not living, too tightly on a budget, not enjoying your life. You're balancing what you're spending with what you're saving, and you're also reducing risk at the same time. So we'll move on to the next slide here. So, avoiding the feelings of anxiety and emotions and feeling overwhelmed, I think is always the key to tackling financial goals. A lot of the time when I meet with couples and there's disagreement, usually it's because there's emotions, maybe some disagreements involved in those discussions. So the earlier you start having those discussions with your significant other or your spouse, and the more you agree upon, or at least outline the plan on how your financial lives are going to lay out, the better it's going to be. Okay, so of course there are general rules and things to follow, but if anything unusual happens in your life, for example, if you start your career late, or maybe you spend years in the military, this can of course cause a delay in you hitting your goals, or your timeline will be shifted. So use this information as a general guideline, but by no means disregard the special circumstances that are happening in your life. So each of the stages that we're going to talk about today holds a different focus area, and it's meant to be built upon the prior stage so that you have a strong foundation, and that foundation you're building, early on in your career, so that when you're in the later stages of your career, you have a very strong platform and can make adjustments upon that. So we'll move on to the next slide. Of course, we'll start with the early 20s, early in your career. Building a foundation, like I said, is the key. And for most people in their early 20s, coming out of college, you're not going to be making a whole lot of money. So, creating a good budget is always going to be first and foremost. And even if you're someone who's in your later stages of your career, if you've never gone through and broken down where your dollars are going from your paycheck every month, this could be a really eye-opening experience, not necessarily fun, but could be eye-opening to see, maybe the spending patterns that you have are not really following, that 50-30-20 rule. So we'll talk about that a little bit later. But, in the early stages of your career, building a budget, managing debt, making sure that you're not getting yourself, into a bad credit situation, and building good savings behaviors is key. So we'll break that down in the next slide. And you guys can follow along here. I have 9 points on the slide here. I'm going to talk in detail about each of these, but this is by no means, an all-encompassing list. I did not want to overwhelm anyone on this call today, but obviously feel free to reach out to me after this call today, and we can send you a much more inclusive list for whatever stage you fall into. But let's talk about some of these pointers a little bit more. So obviously, early in your career, make sure that you have consistent income, okay, regular income, which covers your basic needs. So again, that's going to be your food, your housing, your insurance, your gas, all of the things that you would not be able to live without, okay? That needs to be covered by some type of regular income. In terms of your budget, you should be spending half of your income, roughly half, on housing and food and all the essentials. You should be putting about 20% of your paycheck into financial goals, and then with the rest of the money, spending it the way that you want, eating out, shopping, apps, things like that. And this is not also a list that's in order. It's really meant to be tackled, ideally wherever you see as your weakest area first, and then working towards the areas that are stronger. So this is not in order. You know, another thing you need to really think about as a young person is health insurance. And whether you work for a company that offers some type of group policy or you need to find an individual policy, the key is to get the best coverage for your needs. So if you have, you know, a need or a high risk situation, or, you know, maybe you're perfectly healthy, making sure that you talk to people who are specialists who can tell you honestly without trying to upsell you on more expensive policies what's going to be the best coverage for what you need at that point. Okay. And then another thing that has gotten a lot of discussion lately, especially post-pandemic, is the need to have an emergency savings account, and that you start building this early on in life. So in your early 20s, maybe, you know, $1,000 in an emergency savings account will be sufficient to help cover any emergency things that happen, like you blow a tire, or, you know, you need to replace a stove or something like that, so that you're not putting these things, you know, on a credit card, or you're not taking a 401k loan. Ideally, what you want to get to in an emergency savings account is 3 to 6 months worth of money to cover your essential expenses. So if you figure out in each month you need $1,500 to pay for your food, your rent, and your health insurance, then you need to multiply that by roughly, you know, 3 to 6 months, and you need to put that into some type of liquid account, you know, a savings or maybe a checking account at your bank, so that you can access that easily. And that, so if anything happens and you need to access this money, you'll be able to do that pretty quickly. All right. So another very important thing to follow every year, and actually working this into your annual financial checkup, is, you know, pulling a copy of your credit score, making sure that, number one, there's no fraud going on, that, you know, all of the accounts and the cards listed under your name are indeed yours, and also checking that the balances and the payoff history, all of the information there is accurate, and also knowing what a healthy credit score is for your situation. So not, you know, holding cards that are high interest and holding balances every month. That's kind of common sense. You don't want to be paying interest on credit cards. You want to be paying that off and having revolving credit every month, so that that helps to improve your score in the long run. All right. High interest credit cards, unfortunately, you know, this is something that is absolutely criminal, that we've witnessed over the years, where credit card companies are targeting, you know, college kids and high school kids, unfortunately, to rack up large balances and be on the hook, not being able to pay off what they've spent on it. So definitely steer clear of that. Another thing that we talk about obviously a lot in our industry is the importance of saving early into the 401k plan. So if you work for a company that offers a plan, you know, regardless of whether there's a match or a company contribution, you know, you should be targeting 5 or 6% of your pay to start into a retirement account. Okay, that is a good starting point for most people, but also setting that on an automatic increase, so an auto increase function every year, where you bump that up 1% or maybe 2% every year until you get to a targeted rate of about 15%. This might take you years to get to, okay? Not usually can most 20-year-olds put away 15% or more than that from their paychecks, but it's a good goal to work up to. If you do have a plan that offers a match or some type of company contribution, then that's also a no-brainer. Make sure that you're putting in at least the minimum amount to get the employer contribution. All right, so that's the 401k, and also knowing the difference between Roth contributions and pre-tax contributions is key. Roth contributions, just very quickly, is the after-tax way of contributing towards a retirement account. And the benefit of doing this in your early career is really that, you know, most of us early on in our careers are not going to be making as much in income as we will in our later careers, which puts us in a lower tax bracket. And when you make Roth contributions to the 401k, you're paying taxes on it in the year that you're contributing. So in theory, your tax rate will be lower in your 20s than in your 50s and 60s. So this makes a lot of sense for most people. However, you know, the traditional 401k contribution type, you know, is also a good way to reduce your taxable income for the year. So if you have any specific questions about which one might be better for you, just give us a ring and we can talk through the details of your situation. All right. And what else here? Well, you know, there's a lot to talk about in your 20s, and, you know, I don't need to read the slide to you, but making sure that you are reviewing all of these points every year. And I like the idea of, you know, finding out from your human resources department if there are advisors or even financial wellness programs that they offer where you might be able to just shoot questions over as they occur to you during the year. So, you know, you're not going to probably tackle all of these things all at once. You might end up pulling your hair out, but, you know, you might want to break this up over the course of a couple of years. Maybe early 20s is a good way to tackle it. And really find a group of people, or maybe a financial mentor, somebody who's 10 years older than you or 15 years older than you, who's gone through this stage and can give you some good, sound, objective advice. Okay, so we're going to move on to the next stage, which is, you know, mid-career or 30s. And this is a time where life starts to get kind of stressful and priorities become very clear. And, you know, if you start having a family in your 30s, this is really kind of the game changer. So let's look at some of the points in the mid-career stage on the next slide. So again, I have 9 points here that I have placed on my slide, but it comes from a much more extensive list. First and foremost, you want to make sure that if you are in your 30s, that you've checked off everything from the prior slide in your mid-20s before you move on to this stage, okay? Because again, you want to build upon each stage to have a strong foundation. So within this stage, the things that you, you know, are thinking about is insurance, you know, life insurance. And if there are children or family members that depend on your income for their lifestyle, if something should happen to you, you want to be able to replace that income. And you want to be able to talk to someone who knows and can explain to you the different types of insurance so that you're making sure that you choose the right kind. We do not do insurance here at RSG, but we do have several good partners that we work with. So reach out if you need help with a referral, and we can send you some names and numbers. So 529s, again, if you are having children within the stage and have family members to think about, then funding a college savings plan is another one of those very long-term, it seems like, big projects. And with the cost of education nowadays, it really serves you well to do this sooner rather than later. And this is where I throw in a little nod to my husband, who started a 529 plan before he ever had kids. And we do have 2 kids now. And although the funding started long before they existed, we still may fall short, scary enough. So that is my little personal story to share with you all. So 529 funding, super important. On the retirement plan side, you know, you never want to think about reducing your contributions at this stage because, you know, as you get older, you should be putting more away. But this is also the time where if you are on a budget or maybe a single income, putting money into the 401k as well as a 529 may take a little bit of juggling. However, you want to be shooting for that 15% range while you're in this stage, your mid-career 30s, okay? Because your income should be higher than from the prior stage, and you really want to keep pace with the replacement rate that you're targeting. You're looking to replace about 80 to 90% of your income post-retirement, income that you're used to living off of while you're working. So shooting for that 15%, and this includes a company contribution. So if your company puts in 5, then you do 10. You're looking for a total of anywhere from 15 to 20%. All right, so home ownership by this stage, if owning a home is one of your goals, there certainly should be a plan in stages. There should be savings put into some type of account by this point in your career if owning a home is your goal. It may not be, but should be on the radar if it is. In terms of your housing expenses and overall expenses, again, you're looking to keep everything at around 50% of your monthly pay. All right. I know that depending on where you live, housing can be very, very expensive, and housing alone can be more than half of your paycheck in certain areas of the country. But you're looking to really keep it to less than a third of your income, your household income. And if it goes over by a little bit, then that other areas of your spending, need to be adjusted. Certainly by your mid-30s, running a retirement projection is something that you should be doing on your own account and maybe jointly if you are married or you have a partner, just to get a good idea of whether or not you're on track. Okay, whether you're on track to replace the income, again, that you're needing to replace in retirement to live the same lifestyle. So if your household income is $100,000 at age 67 and you want to retire at that age, you need to make sure that roughly 80,000 or 80% of that 100,000 is coming in through various sources of income, Social Security, 401k distributions, maybe some passive income. You need to make sure that the projections, okay, as early as you can start running them, are on pace to replace that. So of course, a lot of this will be forecasting and maybe a little bit of guessing work with the numbers. But if you are terribly off and you need to make massive changes in what you're saving and what you're spending, it's better to do this earlier rather than later, all right? So student loans, this is probably the biggest blocker that I've run across when I meet with participants that's preventing them from funding the 401k, from funding a 529. Again, education costs are just through the roof now. And it's not uncommon to have student loans be paid well into your mid-career, but it's nice to be able to set a goal and to tackle and have a timeline of having that repaid before your 40s, okay? So spending less than you're earning, we already talked about that. Having a budget where your cash flow is not an issue. Cash flow is tending to be more of a concern earlier on in your career. So, your early 20s where you're still trying to figure it out. Maybe your earnings are lower as a new graduate. But certainly by your mid-career, your mid-30s, you should be spending much less than what you're earning, on a household level. Because if you're not, it means that, nothing is getting accomplished in terms of your short-term and long-term financial goals. You're just surviving month to month. And what that tells me is that your expenses are far higher than what they should be. All right, so we've talked about college savings, we've talked about retirement, we talked about life insurance, budgeting. It's it's interesting when you get to your 30s, especially the end of 30s, and when you start to turn 40s. There's a paper written by MIT Age Lab which states that your 40s are the most highly stressful period in anyone's life, because it's really the convergence of, two things. It's, trying to get your kids older out the door into college, whatever stage they're in, but at the same time starting to deal with the challenges that folks are having to face now during a time period where they're trying to get their own finances in order. So let's look at the next stage here, which is late career on the next slide. Here, what you're trying to do, all while trying to stay sane, is to maximize your own savings, because now you're getting ready. You can start to see kind of the shadows of retirement, and you're starting to picture what that could look like. So in your late career in your 40s, of course, you need to have answered yes to all of the things we talked about from your mid-career and your early career from your 20s and 30s, again, to make sure that you have a strong foundation. But from here, you need to make sure that your retirement account is in good order, because time is ticking. So looking at your retirement projections, are you really on target to replace that 80% of your income based on what your targeted retirement age is, based on the distribution rate of 3% every year, based on your investment strategy and tax efficiency? So these are all things that you should be examining very closely, either with a financial advisor or an accountant, some expert in that field, to make sure that your projections are on track versus your goals. Okay. In terms of, an estate, this is also the time period where you need to make sure that things like your will is in place. Do you have a healthcare directive? Do you have a financial power of attorney, a health power of attorney? All of the grown-up things that you have to have in place should anything happen to you. And I can recite so many stories of participants, even family members that we know and work with, who have not had these things in place and who are now trying to clean up, a mess left, unfortunately, post passing of a person. So that's definitely not something you want to leave to your beneficiaries and your children. So have all of these things in place. And then with, health issues, this is also the time where you start thinking about long-term care, what that means in terms of funding now a separate account if you anticipate you or your partner needing to move into an assisted living facility or to pay for long-term care. How exactly are you going to be able to fund that? Because again, just like college, those costs are, just increasing. And this is also dependent on where you live in the country. These costs can be overwhelming even at times. So late 40s, let me see if I'm missing anything. Just making sure really that your investment profile and review is done every year, at least once a year, if not several times a year. Having all of your estate planning needs in order, making sure your risk tolerance and your investment allocations match your goals. Also, again, looking at Roth versus pre-tax within the retirement account is important, because your situation from an earnings and a tax efficiency perspective might look very different in late career versus early career. So taking a look at all of these things is important. All right, let's move on here. So the next stage is really pre-retirement. Even though folks are living much longer now, well into their late 80s, even early 90s is pretty common right now. So 55 might be an early pre-retirement, but most people that I talk to now still have a goal of, starting to think about that stage in their mid to late 50s. So the focus of this stage really is to reduce your investment risk, all keeping in mind, that whatever the market conditions are at that time, and right now we're kind of going through a very real example of this, that you might have to make adjustments to what your expectations are. So it's important to give yourself a bit of leeway. And if something happens in the markets in the year that you are hoping or expecting to retire, that you have flexibility maybe to continue working, either part-time or full-time temporarily until the markets can recover. All right, so within the pre-retirement stage, you're really trying to prepare for financial independence. So again, making sure that you answer yes and have taken care of all of the prior checkpoints here on the earlier stages in your early and mid and later career stages, making sure all of those things are in place. And you really start thinking about at this stage, whether or not you intend to keep living in the home that you're living in. Okay, so is it possible that you need to move because you can't manage the home that you're living in anymore for physical reasons, or you need, again, assisted living facilities, things like that. Okay, so based on what your thoughts are with that, whether or not you plan to pay off the mortgage, or you take an early retirement, these are all financial decisions that are all surrounding the same core idea of where do you intend to live. And there is an interesting statistic, again, out of MIT Age Lab, that most people will move more times after they turn age 50 than they will in their earlier years. And at first, I thought that was a very strange stat, especially when you think back to your 20s, where you might move, 10 times in a couple of years. But because of the physical challenges and maybe health concerns of managing a large home and then, moving into assisted living, it kind of makes sense. So it is something to think about where you intend to live in retirement. In terms of your investments, making sure that you're starting to transition, and the specific numbers here vary depending on what your personal timeline is, but transitioning your assets towards a more moderate or balanced risk level in anticipation of retirement. This is typically the time that you would do it. Of course, if you have different goals for your retirement monies, if you want it to go to later generations, or if you want it to go to a foundation, you might have a different plan for that money. But in general, if you are looking to retire at normal retirement age, this would be the stage in life where you start thinking about moving it towards a more moderately balanced portfolio. All right. And this is also the age where folks are working closely with financial advisors. Someone who works, on a fee-only basis, who is not going to try to really sell you anything, because at this stage, everything should already kind of be in order, and you just need to make sure that the specifics of it are checked on every year with an advisor, and if anything changes with your goals, that tweaks are made at that time. All right. Illness, of course, is always a concern. You might have a plan to work until you're 67, but if something happens to your health and you're not able to, how are you going to manage that? Where is your income going to come from? What kind of insurance policies do you have to cover the income that you're going to need? If you have a pension from a job that is expected to provide you with annual income, how much will that provide you with? And will that number change between age 55 onwards to your retirement age. Social Security, it's a good time to start thinking about when you might activate this benefit, keeping in mind that we expect fairly substantial changes to the way Social Security is calculated, paid out, possible increases in Social Security payroll taxes. We basically have the next 10 years or so to figure out and make changes to how the benefit is maintained, because we're not expecting to be able to pay out benefits at 100% by the year 2034. So the more engaged and educated you are with this topic, especially if you're in this pre-retirement stage, the better off you'll be. All right, so let's move on. Hopefully I haven't overwhelmed anybody with my checklists. I personally am someone who is more effective when I work off a checklist, but by no means would I give you, 50 things on one checklist to try to tackle at one time. So that's why we've broken it up into different stages. And the concept of building a strong foundation and then further building upon a strong foundation as you get older is one that really resonates well with me, and I would think with most of you. So the questions that you can ask yourself really are, are you on track based on your current age and whatever career stage you fall into with all of the benchmarks that we've talked about? Keeping in mind that most people don't hit every check mark, but it does take them, a while, years, sometimes a lifetime, to work through the different stages. But the easiest way to tackle this is really to pick the area that you feel is weakest, that you need most help with. So for example, if you've saved nothing for retirement and you're in your mid-40s, then maybe that's an area that you really tackle strongly for the next several years. Okay, financial wellness is something that you have to work with. You have to practice this for a lifetime. It's a lot like physical health and mental health and wellness. It's not something that you're going to be able to accomplish quickly. It takes discipline, it takes a plan, and it takes talking really to a lot of people. And to stay on track really requires determination. But hopefully, you're able to talk to us here at RSG, talk to your company, your HR folks, to see if there are additional resources that you can use, whatever stage that you're in, to really get yourself on track, get yourself onto a plan, and really to give yourself peace of mind that you are doing everything that you can possibly be doing to get yourself there. So I believe the last slide here is my information. So drop me a line or shoot me an email if you'd like to talk about any of these items more in detail. We'd love to hear from you. And again, a recording of today's presentation will be available on our website very soon, within a couple of days. But in the meantime, I hope to hear from you guys, and I hope you have a great rest of your day. Thanks again.